A lot of you have commented for me to discuss this company, this fintech stock for a while, especially in the last fintech video. If you missed that, we talked about PayPal, New, Adyen, and Stoneco. That would be in the top right corner. But this company I've never touched on, I never talked about on the channel, and that company is called Shift4. Now, Shift4 payment lately has had ups and downs. That's because, well, there was this announcement that maybe it could get acquired. It got some bids where the value would be close to $7 billion. At that time, the company was worth around $5 to $6 billion. But a couple of weeks ago, there was a report that came out that said that Shift4 CEO says bids from buyers fall short. They say here that they failed to sufficiently value the payment processor, and so acquisition is off the table right now, which could be very good news for long-term investors because the company right now is worth around $5 to $6 billion. It is growing quite fast, profitable as well, so only getting a tiny premium in what we could call right now a bull market would not be such a great deal for shareholders. And so sticking with your position right now could be much better than just selling it just for $7 billion because if the company can continue to grow and exceed expectation or meet analyst expectations, I think it could be worth more than $7 billion. So we're going to have a look at that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So currently this is the state of Shift4. If you look at the market cap, it's now just under $6 billion. If you look at all these metrics here, forward PE, EV to EBITDA, price to sales, price to free cash flow, all lower than their 4-year mean by quite a lot. So yes, you could say it is extremely cheap right now. And I would very much agree with that. Because even if you disregard the 5-year mean, this company has now a forward PE of 18.8 times. EV to EBITDA in the next 12 months, 8.9 times. Price to sales just 1.2 times. Price to free cash flow 14.5 times. And then a price earnings to growth of 0.6. This is very cheap. If we compare it to, let's say, PayPal, for example, I know it's not apples to apples, but hey, since it's in the title, it's not clickbait anymore, so I have to show you. PayPal, which I regard as extremely cheap as well, has a lowered forward PE, 12.7 times, but is also growing slower than Shift4. But if you look at the rest, price to sales, EV to EBITDA, price to free cash flow, even price earnings to growth, PayPal is higher and PayPal is already quite cheap. Now, of course, if we compare it to SOFI, there's no really comparison here because SOFI right now is just becoming profitable, so it has an extremely high forward PE, but even price to sales is much higher than Shift4. Now, if we look at the average analyst price target, that sits now at $90, representing around 30% growth from the price we're at today. If we look at what the analysts are expecting for Shift4 in the next coming fiscal years, you can clearly see that this company is expecting to have quite a lot of growth top and bottom line. Fiscal year 2024, top line growth 45.5% year over year, EPS 30%. With regards to EPS, you're getting almost the same growth for fiscal year 2025 and then another 20.8% in fiscal year 2026. With regards to sales growth in fiscal year 2025, another 27.13% year-over-year growth, and then another close to 22% year-over-year growth in fiscal year 2026. So definitely a fast-growing company. So let's have a quick look at their latest earnings report. So there was a 55% year-over-year growth in end-to-end volume, 33% growth in gross profit, 35% growth in gross revenue less network fees, which was a bit lighter than expected with regards to enterprise deal, but we'll get to that in a second. $19.2 million of net income, 44% growth in adjusted EBITDA, $105.3 million of net cash provided by operating activities, and 33% growth in adjusted free cash flow. They grew restaurant-related SaaS revenue by 69% year over year, went live with their first locations in the UK and Canada, as well as launched an AI-powered restaurant website builder. They added big-name sports and entertainment customers, including New York Yankees, MetLife, New York Giants and Jets, LA Dodgers, LA Rams, San Diego Padres, and Cirque du Soleil. What could have been better is this GRLNF is gross revenue less network fees. That came in a bit light as enterprise deals were delayed and the timing of certain multi-billion-dollar gateway migrations. We expect that the revenue associated with these opportunities will expand in the years ahead. We can't always control the timing of our largest enterprise opportunities, so we focus on the KPIs we can control, and I'm proud of our expanding adjusted EBITDA margins and free cash flow generation. And I mean, if you look at the performance across the years, across the quarters, this is quite a great investor story. Now, maybe the stock does not reflect that just yet, but if you look at the underlying business, I do think that the underlying business is doing what it should be doing. Then if we're looking at the fiscal year 2024 guidance, you can see here end-to-end payment volume of between 53 to 68% year-over-year growth. That's quite a range, not gonna lie. Gross revenue less network fees between 38 and 44% year-over-year growth, and then adjusted EBITDA between 38 and 47% year-over-year growth as well. With regards to full year adjusted free cash flow, over 58% adjusted free cash flow conversion. Back in 2021, they had set some medium-term goals, and right now they are on track to exceed those medium-term goals. As you can see, end-to-end volume on track to exceed that. Gross revenue, same there, just up 5%. Then the gross revenue less network fees, also on track to exceed those numbers. Now, for those of you that don't know, the CEO of Shift4 Payments is called Jared Isaacman. You might know who he is if you're a fan of SpaceX, if you're a fan of space exploration, because he was the guy in inspiration for the world's first all-civilian mission to orbit. To me, having this type of CEO, in my opinion, I see him as a quality CEO, very, very mission-driven, focused. He knows that his company is worth more than the bits that came in. A lot of other CEOs would have said, you know what, okay, our stock doesn't move, market doesn't appreciate us, okay, let's get acquired at a small premium. I'll take my payday and focus on space stuff, maybe buy an island, maybe buy a yacht, and retire, and so on and so forth. But no, he said no, he thinks the company is worth more. He knows what his business is doing, so he's expecting more growth, which means that eventually the stock will follow as well. I like to see that. Now, as the title mentions, is this a better buy than PayPal and SOFI right now? To be honest, I don't think you can go wrong at these prices. That's my honest opinion. I don't own Shift4. I own PayPal and SOFI. Right now, if I'm looking at the stock, yes, in the last couple of days, it did dip under the 200-day moving average, but more recently, it made its way back up. Of course, mid-March, you had that gap down here. That's because of the news that came out that they're not looking to get acquired because of the low bids. Then we continue to go down, down, down under the 200-day moving average. And now in recent days, we made our way back up. Pre-market, we're at $70. RSI looks okay, neutral, but has some positive momentum. Overall, if you're holding Shift4, I do think that it's good news for you that they're not getting acquired at just $7 billion. If you have PayPal or SOFI, I don't think you should be selling PayPal or SOFI to buy Shift4, but I don't think you could go wrong by having Shift4 in your position. Looks like a solid company, solid business, good CEO. Then eventually, if a bid comes in, I do think that it will have a much bigger premium than just the $7 billion, since the company is now valued at just $6 billion, growing quite fast, top and bottom line, profitable. What more could you ask? Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.